we are moving sharply in the wrong direction. Inflation is getting worse as the Fed is pouring gasoline on the fire. Now, there are a lot of people that think, well, because of this inflation, maybe they're not going to cut as much in 2025. That's one of the reasons that you're getting this strength of the dollar. You got a big drop in gold the last few days. Gold's about $50 an ounce lower than it was when I did the podcast on Wednesday. It was at 2,700, basically just below. In fact, it went to 2,717 or so after that. It had a little rally. It almost got, almost got close to new highs. And then these bad inflation numbers clobbered it. And now gold is back to 2650.
In today's news recap section of the episode, gold price faces strong headwinds ahead of Federal Reserve meeting. After testing resistance at $2,700 at the start of the week, gold is once again on the back foot as stubborn inflation takes its toll on expectations surrounding the Federal Reserve's easing cycle. The precious metal received a much-needed boost earlier this week as investors reacted to news that China's central bank resumed buying gold. After a 6-month break, data from the People's Bank of China showed it purchased 5 tons of gold in November. According to many analysts, the data underscores China's significant role in the gold market and highlights healthy central bank demand heading into 2018-2025. However, the precious metal continues to face near-term volatility as attention now shifts to the Federal Reserve's monetary policy meeting next week. According to the CME FedWatch tool, markets have fully priced in a 25 basis point rate cut following the Fed's final meeting of 2024. There is growing uncertainty regarding the duration of the current easing cycle in the new year. The gold market began selling off this week after the U.S. Labor Department reported that its headline producer price index rose 0.4% in November, following October's unrevised 0.3% reading. Over the last 12 months, headline wholesale inflation increased by 3.0%, well above the consensus of 2.5%, and October's upwardly revised 2.6% reading. The rise in wholesale inflation suggests that the threat to consumer prices remains elevated, which some economists say will discourage the U.S. central bank from raising interest rates. In its outlook earlier this week, analysts at Wells Fargo said they expect only one rate cut next year. Similarly, Bank of America recently forecasted just 2 rate cuts in 2025. Naeem Aslam, Chief Investment Officer at Zay Capital Markets, said gold. Investors should prepare for potential weakness next week as the Federal Reserve pares back rate cut expectations. Another analyst, Lukman Otanuga, is more neutral on gold, noting that the precious metal is caught in a tug of war. He added that while a hawkish Fed is negative for gold, the yellow metal still retains plenty of bullish momentum. Now we'll show you the best clips of the latest interview. But first, hit the like button, smash the subscribe button, and check the pinned comment because we're offering an exclusive discount on NordVPN, an essential tool for gold and silver stackers who value privacy and security. Make sure you keep your data private, especially if you're browsing investing-related material. And if you want to learn how to stack and how you can benefit from the gold-silver ratio to make savvy investment decisions, check our guide at goldsilverstacks.com. Enjoy the episode.
We are moving sharply in the wrong direction. Inflation is getting worse as the Fed is pouring gasoline on the fire. Now, there are a lot of people that think, well, because of this inflation, maybe they're not going to cut as much in 2025. That's one of the reasons that you're getting this strength of the dollar. You got a big drop in gold the last few days. Gold's about $50 an ounce lower than it was when I did the podcast on Wednesday. It was at 2,700, basically just below. In fact, it went to 2,717 or so after that. It had a little rally. It almost got, almost got close to new highs. And then these bad inflation numbers clobbered it. And now gold is back to 2,650. But inflation is good for gold. I've been talking about this paradox for years now because the markets don't get it. When the markets see hotter than expected inflation, what the traders believe is, the Fed's going to have to fight harder to win the inflation war. And that means higher for longer, not as many cuts, a tighter Fed. That's good for the dollar. That's bad for gold. They're wrong. What higher than expected inflation means is that the Fed already lost the war on inflation. It's not going to fight harder. In fact, it's going to surrender. Inflation won. It just hasn't admitted that yet. It's still pretending. The Fed is still pretending that it won. It didn't even come close to winning. It's already surrendered. The markets just haven't figured that out yet. But at some point, they're going to realize that that white flag has been waving, and that is bullish for gold. Higher inflation is always bullish for gold, especially when the Fed can't do anything about it. Their hands are tied behind their backs. In fact, before too long, probably during the Trump administration, the Fed is going to have to fess up and say that it's willing to accept higher inflation, that that's just the price we have to pay to stimulate the economy, to deal with the debt, to whatever. It's going to come up with an excuse. I don't know if it's going to raise its official target to 3 or whatever it's going to do, but it is going to be cutting rates. It is going to be doing quantitative easing, even as the inflation numbers move further and further north of 2%. And in fact, we got numbers on Thursday for jobless claims that unexpectedly shot up from 225,000 last month to 242,000. Last week to 242,000 and in the last week. And the 4-week moving average jumped up from 218.50 to 224.25. This is the highest number of claims we've had in a while. And again, could be the beginning of a big trend on increasing unemployment. And so, the economy is weak. Again, the weak economy is the reason that Trump was elected. And that weak economy, what are the reasons that we have so much debt and we're now so vulnerable to rising rates is because she kept rates at zero for so long, allowing the government to finance all this debt short term at low rates and thinking it was no problem. In fact, when she became Treasury Secretary, she continued the process. And even though she had the opportunity to try to lock in longer duration bonds at low rates, she decided as Secretary of the Treasury to keep issuing short-term paper, knowing that interest rates are going to rise. In fact, I pointed this out on my podcast. Nobody else in the mainstream media did, which is why you don't have to watch the mainstream media. I just watch it to see the stuff they get wrong, and then I tell you the stuff that's right. But what Janet Yellen said in response to a question about the debt, she was asked, are you worried about the national debt and the size of the debt? And she said, no, I'm not worried at all, because the key is the financing costs. And interest rates are really low, and so it doesn't cost us a lot to finance the debt. And I said at the time, yes, but interest rates aren't going to stay low. In fact, the Federal Reserve just told you they're going to start hiking to fight all this inflation that you helped create. So she specifically said the debt isn't a problem because rates are low, and now she's apologizing for not doing more about the deficit, especially since rates have gone up. Well, duh, we knew they were going to go up. She knew they were going to go up. I don't even think, sorry doesn't cut it. When you do this intentionally, she owes a lot more than that half-assed apology for the part that she played.
In the continuation of the episode, Peter Schiff highlighted the troubling persistence of inflation in the U.S., pointing to higher than expected data from both the Consumer Price Index and Producer Price Index. November's PPI rose 0.4%, double the prior month's increase, while the year-over-year rate climbed to 3%, signaling mounting price pressures. Schiff criticized the Federal Reserve's stance, arguing that inflation is not easing as the central bank claims, but rather bottoming out and poised to accelerate. He asserted that the Fed has already lost the war on inflation and is unwilling to fight it further, predicting more rate cuts and a de facto surrender to higher inflation. Gold, Schiff contended, is positioned to benefit significantly from these dynamics. Despite recent declines to $2,650 per ounce, he views the pullback as a buying opportunity driven by market misconceptions. According to Schiff, traders mistakenly believe hotter inflation will force the Fed into a stricter stance, strengthening the dollar and weakening gold. Instead, Schiff argued that higher inflation exposes the Fed's inability to act decisively, which will ultimately drive gold prices higher as the markets adjust to the reality of sustained monetary easing. On the job market, Schiff pointed to rising unemployment claims, which hit 242,000 last week, as an early warning sign of economic weakness. He dismissed claims of a strong economy, calling the reliance on fiscal stimulus akin to a patient on life support. Moving forward, Schiff expects worsening economic conditions, fueled by exploding deficits and persistent inflation. He predicted that these factors will ultimately push the U.S. into a deeper recession, trigger a realignment in global currencies, and bolster demand for hard assets like gold. Don't forget to hit the like button and subscribe to the channel so you never miss our daily recaps. If you're looking to learn how to stack gold and silver effectively, check out the Stacker's Handbook at goldsilverstacks.com. And while you're at it, take advantage of our exclusive NordVPN special offer.
As far as expectations, right? It wasn't really worse than expected. It was as expected, which was bad. Right. So the consensus was for an increase of 0.3 in November, and we rose by 0.3. And that was higher than the 0.2 from October. Year over year CPI was up 2.7, higher than the 2.6 year over year the prior month. So we're going in the wrong direction. Core, ex food and energy, up 0.3 on the month. Again, another 0.3. We've been there for like the last 4 or 5 months in a row, I think. And the year-over-year core was also up 3.3. We've been stuck at around 3.2, 3.3 for month after month after month. Nowhere near 2%. How Powell can look at these numbers and conclude that we're on a glide path to 2%, it's beyond me. You can't. All these numbers confirm is that inflation is bottoming out and is headed much higher. And it never got anywhere near 2%. Especially if you look at the PPI, Producer Price Index, which is a leading indicator for the CPI, because generally the businesses have their prices go up first, and then they pass it on to the consumer second. So the PPI is more forward-looking than the CPI, and there the numbers were really bad. So the expectation for the increase in November producer prices was 0.3, and we got an increase of 0.4. And that was double the increase from the prior month of 0.2. So we're really heading in the wrong direction fast. On the year over year, producer prices was supposed to be 2.6. It's 3%. We got a 3 handle now, not a 2 handle. Last month, the year over year PPI was 2.2%. Now it's 3. Now, I've been saying this on my podcast that the year over year numbers are going to start to get a lot worse due to the comparisons. And that's what's happening. So now we have a 3 handle. How long before we have a 4 handle? Not long. Look at the ex food and energy. There, it was a little bit better, actually, because it was only up 0.2, which was the consensus, right? So, and that was a little bit less than the 0.3. But the year over year core was supposed to be up 3.2. It was up 3.4. That was much higher than the 3.1 year over year from the month before. So the Fed wants 2% core. We're at 3.4 and headed in the wrong direction. Yet the Fed is going to cut rates by another 25 basis points. By the way, the ECB cut rates 25 basis points this week, and the Swiss National Bank went for the supersize 50 basis point cut. They cut in half. I think they went from 1% to 0.5%, right? Inflation is going to rear its head in a big way all over the world. The Eurozone, Japan, all these countries that are cutting rates should not be cutting rates. inflation is going to roar back stronger than ever, right? Worse than what we had in 2001, 2002. That's what's coming. Ex food and energy year over year was 3.5. So these are strong numbers. Now, on top of that, adding insult to injury were the import-export prices that came out this morning. They were looking for a drop of 0.3 in import prices. Instead, we got a rise of 0.1. And year over year, they were looking for an increase of 1. We got an increase of 1.3. On the export prices, they were looking for a drop of 0.1, and we were unchanged. And the year over year export prices are up 0.8. The month before, they were down 0.1. So again,
that's it for today's video on Peter Schiff's take on gold, silver, Bitcoin, and the economy. Do you agree with his views? Are you on board with his criticisms, or do you think he's missing something? Let me know your thoughts in the comments below. I'd love to hear your perspective. Don't forget to like this video and subscribe for more content diving into the world of finance, economics, and the voices shaping the conversation. Thanks for watching, and I'll see you in the next one.